VOO is now one of the largest investment products on the planet, with around $800 to $850 billion in assets as of December 2025, and a rock-bottom 0.03% fee. But with rivals like SPY, IVV, and SPLG all tracking the same S&P 500 index, the real question for 2026 is simple. Is VOO still the best S&P 500 ETF, or is it just one great option in a sea of clones? If you had put $10,000 into an S&P 500 ETF in 2015, you'd be sitting on roughly $40,000 today. The wild part? Whether you chose VOO, SPY, IVV, SPLG, or VTI, your ending balance would be shockingly close. So in 2026, the edge isn't huge returns, it's fees, taxes, and tiny tracking differences that quietly add up. Quick disclaimer, not financial advice. Always do your own research. VOO is the Vanguard S&P 500 ETF. It holds over 500 of the biggest public companies in the US, designed to mirror the S&P 500 index. Think of it as one ETF that lets you own a tiny slice of Apple, Microsoft, Amazon, big banks, healthcare, industrials, and more. As of December 2025, expense ratio 0.03%, assets under management roughly $790 to $850 billion, dividend yield around 1.1 to 1.2% trailing 12-month yield with quarterly distributions. Performance is roughly 13 to 18%, 5-year annualized about 15%, 10-year annualized about 14.5%. Since inception in 2010, about 14.6% annualized. When you buy VOO, you are buying the market average. You're not trying to beat the S&P 500, you are trying to match it as cheaply and tax efficiently as possible. All of these funds give you very similar exposure. SPY, SPDR S&P 500 ETF Trust, State Street, the original, launched in 1993, IVV, iShares Core S&P 500 ETF, BlackRock, SPLG, SPDR Portfolio S&P 500 ETF, a cheaper SPY-style fund, VOO, Vanguard S&P 500 ETF, our focus, VTI, Vanguard Total Stock Market ETF, broader than S&P 500, but often used as a competitor in core US discussions. You could also mention SCHX or SCHB from Schwab, but we'll keep focus on the Vanguard versus SPDR versus iShares giants. Bottom line is, income differences between these S&P 500 funds are tiny. The main differences are fees, structure, and how often you trade. If the S&P 500 returns 10% and your ETF returns 9.9%, that 0.1% shortfall is tracking error plus fees and small frictions. 10-year annualized total returns. VOO about 14.55%. SPY about 14.49%. IVV between 14.5 and 14.6%. SPLG about 14.56%. VTI, total market, around 13.97%, just slightly less. 5-year annualized VOO about 15.35%, SPY 15.29%, SPLG 15.38%, VTI about 14.50%. All four S&P 500 trackers are within a few hundredths of a percent of each other, essentially identical. When you look at the 3-year and 5-year performance tables, the annualized returns differ by only 0.01 to 0.05% between VOO, IVV, and SPLG, and SPY is only slightly behind because of its higher fee. One of Vanguard's superpowers with VOO is tax efficiency. VOO is structured as an ETF share class of a Vanguard mutual fund, which historically has allowed them to manage flows and redemptions in a way that minimizes taxable capital gains distributions. In practice, that has meant VOO has rarely, if ever, paid out large capital gains, especially compared with older structures. IVV and SPLG are also highly tax efficient, and SPY, while solid, can occasionally have more distributions because it's an older unit trust structure. For a long-term investor in a taxable account, fewer capital gains distributions means you control when you realize gains, not the fund manager. For most ETF investors in the US, VOO, IVV, and SPLG are all considered very tax efficient. Vanguard's structure is a slight plus, but not a huge differentiator anymore versus other true ETFs. If you invested $10,000 in January 2015 and held until December 2025, reinvesting dividends, what would you roughly have? Using the 10-year annualized returns from stock analysis, around 14.5% for VOO and peers, we can estimate at 14.5% annualized for 10 years. $10,000 times 1.145 to the power of 10 is approximately $38,700. So ballpark numbers: VOO, about $38,700. SPY, maybe $38,300 to $38,600. IVV, about $38,600 to $38,800. SPLG, similar to VOO and IVV. VTI, slightly lower, maybe around $36,800 to $37,500. The point is, the difference between picking VOO versus IVV versus SPLG a decade ago is measured in hundreds of dollars, not tens of thousands, on a $10,000 starting balance. For a beginner, the key is not finding the perfect S&P ETF. It's picking a low-fee one, sticking with it, and letting compounding do its thing. Expense ratios. This is the annual fee you pay to own the ETF. 0.03% means you pay $3 per year on a $10,000 position. 0.09% means $9 per year on that same position. That sounds tiny in 1 year. But over 30 years, extra fees stack on top of each other and compound against you. If the index returns 10% and your ETF returns 9.9%, you're losing 0.1% to implementation. If that gap stays small and consistent, it's fine. If an ETF regularly lags more than the fee would suggest, it's doing a worse job tracking. In the S&P 500 world, VOO, IVV, and SPLG have tiny fees and extremely small tracking error. SPY has a slightly higher fee, but also world-class liquidity. For buy and hold investors, VOO, IVV, and SPLG usually win. VOO pros: ultra-low 0.03% expense ratio, massive AUM and high liquidity, very tight tracking to the S&P 500 index, strong tax efficiency, and a long, clean track record. Vanguard brand and investor-first culture. VOO cons: SPLG edges it in fee at 0.02%. IVV offers equally low fees and similar structure. SPY still dominates for options trading and intraday liquidity, more relevant for traders than long-term investors. So is VOO, the best S&P 500 ETF for 2026. For a long-term buy and hold investor, VOO, IVV, and SPLG are essentially a three-way tie at the top. VOO wins on Vanguard loyalty and brand and is an excellent core holding. SPLG technically wins on fees by 1 basis point. IVV and VOO are virtually identical on cost and performance. For most beginners, the best ETF is the one that has a low fee, tracks the index tightly, is easy to buy at your broker, and that you can emotionally stick with for decades. On that score, VOO absolutely remains in the top tier for 2026. Step 1. Check your broker. Make sure your brokerage offers VOO, SPY, IVV, or SPLG with zero or low commissions. Step 2. Decide your core percentage. Ask yourself, what percentage of my stock portfolio do I want in a broad U.S. index? For many people, 40 to 80% in an S&P 500 or total market fund is a common starting point, depending on age and risk tolerance. Step 3. Pick one primary ETF. To keep things simple, choose one main S&P 500 ETF, VOO, IVV, SPLG, or your preferred option, and stick with it. Avoid spreading the same exposure across too many similar ETFs. Step 4. Automate. Set up automatic monthly or quarterly investments. Dollar cost averaging smooths out volatility and removes emotional timing decisions. Step 5. Reinvest or take dividends. In the accumulation phase, reinvest the dividends automatically. In retirement, you can have them paid out as part of your income. Common mistakes to avoid: chasing the lowest fee by 0.01% while ignoring your own behavior. Obsessing over 0.02% versus 0.03% means nothing if you panic sell in a downturn. Constantly switching between SPY, VOO, IVV, SPLG. Every switch can trigger taxes and break your compounding. Pick one and stay married for a while. Assuming VOO is safe in the short term. VOO is diversified, but it's still 100% stocks. In a crash, it can drop 30 to 50% like any equity fund. Over-allocating. Putting 100% of your net worth in a single S&P 500 ETF might be too aggressive if you're near retirement or need cash soon. Ignoring international and bonds. VOO covers U.S. large caps only. Most investors also want some global and bond exposure for balance. If you've watched this far, you now understand the real truth about VOO. It's not a magic ETF. It's a near-perfect execution of a very simple idea. Own the S&P 500, pay almost nothing, and stay invested. So, is VOO still one of the best S&P 500 ETFs for 2026? Absolutely. But so are IVV and SPLG. The biggest win is picking one good fund and sticking with it for the next 10, 20, 30 years. Which S&P 500 ETF do you use right now? VOO, SPY, IVV, SPLG, or something else? And after seeing the numbers, are you thinking about switching or staying put? Drop your answer in the comments. If this breakdown helped you feel clearer about your core ETF choice, please hit like, subscribe, and tap the bell so you don't miss the next investing deep dive. Thanks for watching, and keep your fees low and your time horizon long.